Hey guys, Mr. T here. This is another video. This one is on price, earnings, or PE ratio. So in the previous video on share listings, we sort of glossed over what PE ratio was because we're actually going to do calculations on it in this particular video. So we briefly sort of touched on the idea of PE ratio indicating the value of a company a bit better than just looking at the share prices. Why is that? Because the PE ratio is calculated by dividing the market value of the company, how much the shares are worth each, by the amount of earnings the company makes per one of those shares. So this lets you analyze the valuation of a company shares relative to how much money it's actually making. So essentially the way you calculate PE ratio is the share price divided by the earnings per share. The only problem with that is we need to work out what the earnings per share are. So the earnings per share are calculated from last year's profits divided by the number of shares the company has on issue that's been divided into. So essentially the earnings per share is calculated by the net profits from last year divided by the number of ordinary shares. Don't worry about ordinary the term ordinary shares for now. That will be gone on to in detail when it's relevant. So let's say a company, so it's a quick example of an interpretation. Let's say a company had a PE ratio of 14, not dollars, just 14. Ignore the dollar sign. 14. At the most basic level, you could interpret that as investors are willing to pay $14 for every $1 of earnings per share that the company makes. That's at the most basic level. However, there's a table that I referenced before, which is an additional interpretation you'll want to use in your DIs. This is an added guide to PE ratio interpretation, so this is in your book, but I've got it here as well. So this column is going to be the PE ratios that we're referring to, and this is how you would interpret it. If there's no PE ratio, that means the company made no earnings. If the PE ratio is between 0 and 10, either the company is being undervalued or earnings are predicted to decline. So people are a bit wary of it and they think the share price is going to go down. If the PE ratio is 10 to 20, then it's okay. The company is considered reasonable value to buy. If it's between 20 and 30, either people are overvaluing it or earnings have decreased since the last report. So they're on the way down a bit and they're being said to be worth more than they should be. Lastly, if it's 30 plus, so it's a really large number, either people are really speculating it's going to grow a lot or people are already being really positive about it. So if we run through an example here, before that, this table is only a guide. Remember that, okay? So this isn't a be-all and end-all. Obviously, you'd have to be a shares expert to understand what PE ratio means. Just at this level, you can use this table for your DIs and any questions about it as an interpretation. Just keep in mind, PE ratios can only be compared to other current PE ratios. Let's say a PE ratio of 30 one year, you're not going to be able to compare it to the PE ratio of the previous year. It's only other current ones, and you can only compare PE ratios in the same industry. So let's run through an example now. HWB Industries reported a net profit of $36.5 million for ordinary shareholders, and it's got 73 million ordinary shares on issue. What's the PE ratio if the market value is $8? So A, PE ratio is going to be share price over earnings per share. The only problem is we don't know what the earnings per share are. We need to work it out. Earnings per share equals the profit, 36.5 million, so 36,500,000, divided by the number of shares on issue, which is 73 million. So we need to work out what the earnings per share are. I just grab a calculator. 36,500,000 divided by 73 million, 0.5. So the company is earning it's earning 50 cents per share. And the PE ratio then is the share price, and we've been told the market value is $8, so 8 divided by earnings per share 0.5. 8 divided by 0.5 is going to be 16. So it's got a P ratio of 16. And our basic interpretation, people are willing to pay $16 for this company's shares for earnings, for every $1 of earnings it makes, or the other interpretation is the company's reasonable value. B. If the market value increases to $12, calculate the new PE ratio. We can do this straight away because we know what the earnings per share are. So it's going to be 12 on 0.5. That comes to 24. So the basic interpretation of that could be that people are willing to pay $24 per $1 of earnings, which sounds pretty good, but take that with a grain of salt, because in the table 20 to 30 indicates it may be overvalued or earnings have decreased since last report. And so that sort of agrees with this number, because, okay, people are willing to pay $24 per $1 earning, but if you look into it, this calculation has been made with the earnings per share hasn't increased. It's not earning any more money per share than it was before, yet it's being valued at $12. Hence, it's possibly being overvalued, and that's the reading from that table. But just remember, that's still just a guide. Right now, at your level, you're fine to interpret it in that way. So C, the company's involved in a scandal and the share price drops to $5. What happens to the PE ratio? PE ratio is going to be $5 divided by 0.5 is going to be 10. So if you think about that, the interpretation could be people are only willing to pay $10 per $1 earning. The PE ratio is decreased, and we are looking at either of these two. It's either considered reasonable value, but rather be pessimistic. It's to go 0 to 10. It's either undervalued or earnings are predicted to decline. Now the interpretation here could be that this calculation is still based on the earnings per share of 50 cents per share. So its earnings per share hasn't changed, yet people saw the scandal and reduced its worth in their eyes to only $5. So in this case, it's probably undervalued instead of predicted to decline. It's still earning as much money per share as it was before. It's still calculated with 0.5. The only thing that's changed is its market valuation of 5. So it's likely to be undervalued in this situation. So hopefully that helps you along a little bit with PE ratio and interpreting it. Remember, this is a bit fuzzy, okay? You're not a shares expert. I'm just giving you tips and techniques for the year 12 level to give you an idea of how you could interpret these numbers. If you ever were to do shares in future, then you would go into more depth about it. So hopefully that helps you out, and I'll see you in the next video.